The Federal Reserve's policies are always pushing up inflation. There was somebody commenting on my video that didn't actually watch my video, but they were commenting on the video suggesting that there isn't going to be inflation and the stock market is going to continue to accelerate, and so is the housing market. And I have to just simply wonder what kind of world these people live in when they're using the official indicators of inflation as documenting inflation. I don't understand. But anyway, the point here is that if you look around, you're going to see that inflation. You just have to choose where you're looking, not basically choose to look away from where they're telling you to look. And this right here is about oil. Crude oil, which has already accelerated. I mean, the last time I checked, it's been a couple of days, but it was around $60 a barrel, $60 plus actually, for both Brent and WTI, and just showing you that it has really come up from the bottom. And this article is talking about the potential for $100 barrel oil. We've seen that before, and it always takes a toll on the economy as a result of that. It becomes very expensive to move stuff around. There's no doubt certain companies do benefit from it, but of course, having very expensive oil historically, in a historic sense, is generally not a good thing for the economy as a whole. While oil's dizzying collapse is still fresh for many traders, rumblings are starting to emerge that by the end of the next year, prices could once again top $100 a barrel. This just shows you in the chart right here, giving you an idea of where this has been. The chart begins around 2014. And then if you remember, I mean, my goodness, some of that oil was moving towards, this is Brent oil, but some of the oil contracts were in the negative. And that just gives you an idea of how, rapid this can move up and down. And, you're looking at it above $60 a barrel today. And already compared to where it was for the longest period of time, it was, right around that $40 a barrel. So there's definitely a premium today. And at the same time, you're starting to see that more of the companies in the US can become profitable if the prices do continue to push higher. Not at zero where it was, not in the negative where it was, but certainly at these higher prices, they're going to become profitable. So that's something that people should be keeping an eye on. I do not give financial advice, but if you are looking for potential different categories, sectors, and so on, remember that if the price stays elevated, some of the US companies will probably do well. There's more to it than that, but that's something to think about. Speculators are getting in on the action, increasing bets in the options market that oil will reach the level by December 2022. That's the expectation on the traders. We'll see what happens. Lumber prices are soaring. Why are the tree growers miserable? Sawmill operators harvest gains while southern landowners struggle with tree surplus. Quote, I'm not making anything. So what are we talking about here? I have shown you that we could see the lumber prices soaring to record highs right now. And yet the guy's saying, I'm not making anything. So what's this all about? Well, this is an interesting article out of the Wall Street Journal. I don't have time to get into it all. The Wall Street Journal articles are usually quite lengthy, but I think it's important to take a look at this because it's not just about what you're seeing with the statistics and the indicators. There's more to it than that. The same thing applies to the farmers. Do the farmers necessarily benefit because the prices have gone much higher? Apparently, that's not always the case. You still have them going bankrupt. You still have them dealing with issues here. All right. Now they're just showing you the unexpected boon to the lumber industry because of what happened here. You could see that the housing prices, the actual construction costs have gone up quite a bit. Hunkered down homeowners remodel en masse, and low mortgage rates drove demand for suburban housing. Lumber supplies tightened up and prices smashed records. You must be making a lot of money. That's the quote. And then he said, I'm not making anything. Timber growers across the U.S. South where much of the nation's logs are harvested, have gained nothing from the run-up in prices for finished lumber. It is the region's sawmills, including many that have been bought up by Canadian firms, that are harvesting the profits. Interesting, right? There's definitely more to it, but I thought this would be something to think about as we go on, not just with lumber, but think about how this works for oil and how that translates to gasoline, the refineries. It's just something that, we should always be paying attention to. When we see the price of oil coming down, the price was in the negative at one point, or is extremely low, historically low. And then what happened to gasoline? Well, it certainly came down. It was cheap in a lot of places, but I found that it didn't come down quite as much as what we saw with the price of oil. And then you look at the price of gasoline coming back up, and then the price of oil coming back up, and it's still elevated. The price of gasoline never dropped down to that level, never gone back to fair value or whatever you want to call it. So there's a disparity in there, in between the raw materials and then the finished product. So that's something that we should be thinking of in all commodities, as well as in other sectors too. Understand the raw material side of it and the finished product, and who is ultimately benefiting the most in the situation. So when you're going through your investment strategy, know, okay, well, lumber is going up. Maybe I should buy this company. Well, we've got to think about it on the level that we're talking about here. I hope that make myself clear here. This brings me into real estate. We're going to talk about this really briefly. Richer than the Big Apple, London overtakes New York as home to the most dollar millionaires, with 875,000 living in the capital, now boasting assets worth more than 720,000. I think it's important to look at, that's pounds, by the way, looking here at what has happened though with New York, because many of them have left, the businesses have left. But at the same time, there are those who will make more than ever before. So there are different trends. So always watch that. It's not necessarily what's happening in London. There's also issues in New York. This article here, just to cover really briefly, is talking about the housing market. It's really red hot at this point. There are growing concerns about how much longer this strength can last. They talk about Home Depot, they talk about Lowe's, both doing well as their companies are just reporting these fantastic earnings and so on. But the concern here is that rising interest rates will have an impact dramatically on their business. And that is absolutely true. The question is, what is the Federal Reserve going to do? You can see that long-term rates have been rising higher. Will the Federal Reserve come in and squash those down and completely go Japanese? We'll see. Household net worth as a percentage, DPI versus debt. So we're looking at the disposable income, and that just gives you an idea of what's been happening over, the last several decades, 1950 up until now. And the only real reason I mentioned this is this: net worth increases requires expansion of debt. That's very clear. The problem here is that because the debt has become cheaper and cheaper over time, that has enabled assets to rise significantly. Okay? Now, we've been riding this whole low interest rate thing for years and years and years and years. And the hope from those in the financial industry, from those in the real estate industry, is that this will persist forever. But we know that that cannot be the case. That can't be the case. Nothing goes on forever. And as soon as we get just an inching up of interest rates, we're going to be left with chaos that they cannot resolve. Yes, don't worry. They're going to take care of it for you. I swear they'll do that for you. But they've told us so many lies before that they'll make sure that doesn't happen, right? But actual, real, honest inflation will force their hand. And ultimately, that's only the surface level. We know the whole point is to create a world in which there are a very small group at the top and everybody else. And the more people that they get to force themselves into risky bets and crush them, the better they'll be. This is also out of Real Investment Advice, a resource that I love to check out daily. Okay. The Federal Reserve's problem is that they have now pushed yield spreads across the entirety of the credit spectrum to record lows. The Fed's suppression of rates to bail out the bond market in the short term has created a long-term problem of mispricing risk. Absolutely, completely agree with that. That's something we talk about all the time. As they mentioned here, the moral hazard in the credit markets created a record number of zombie companies in the process. They pull up these two charts right here. You probably can't read the font, but essentially what it says is US hits all-time high in zombie companies. And on the right-hand side just shows you zombie companies equal weighted pulling ahead of the S&P 500. I mean, it's crazy, and people just love it. But I think that the fact remains is that this is extremely dangerous for you, for your savings, for your retirement, for your livelihoods. Nobody wants to own up to that information. This channel long ago plateaued, and people simply don't want to hear it. I get hate mail every single day, saying that I should shut up, that I should simply tell everybody what to do, give financial advice, say buy this stock, buy that stock, and everybody's going to love it. You know what? There's some channels out there. I wish I would name them. I wish I could name them, but no thanks. I'm just going to reserve my information. They take information that is so basic, and their channel, one specifically I'm thinking of, it's got over 2 million subscribers. They're featured on CNBC and so on. And what? They take the most basic information, spell it out for people, and they just give them what they want to hear. I'm not here just to give you what you want to hear. I'm here to give those who want to know the truth, to have some actual real data. And I can't believe it, but I shouldn't be surprised, because people don't want to know the truth. The average person doesn't want to know the truth. They want to sit there and suck their thumb. They want to be babies. All right, at the bottom here. Eventually, when rates rise enough, these zombie companies will be unable to refinance debt for their continued survival. Once bankruptcies begin to spike uncontrollably, investors will demand to get paid for their investment risk, such has occurred in the past with relatively dismal outcomes. We know what the case is. We know how this is going to turn around. It's only a matter of time. But people will be the most complacent ever when it happens. If that's 2 years from now, that's 5 years from now, 10 years, the longer it takes, the worse it's going to be. But nobody wants to simply take a few measures to protect themselves. No, they put all the risk in, and they'll get what they deserve. Charlie Munger says novice investors are getting lured into a bubble in a dirty way by Robinhood. Charlie Munger said the momentum-driven trading frenzy by amateur investors on commission-free trading platforms like Robinhood will not end well. Quote, "It's most egregious in the momentum trading by novice investors lured in by new types of brokerage operations like Robinhood, and I think all of this activity is regrettable." Quote, "It's a dirty way of making money." Very good point in the way that they've been doing their business. They're gamifying it all. They're making it so exciting. Instead of simply giving people the tools that they need to make the right decisions, they're trying to gamify it. They're trying to get people to put more and more and more. And that never ends well. Last point I want to make, Instacart exploring use of robot-driven warehouses. So right now you've got a bunch of people that go out there, they go to Walmart, they go to the stores, picking up the groceries for you, they bring them to your home. But what if they had facilities, warehouse facilities, think of like Amazon type facilities, where they're just putting the food at these locations. They've already got you as a customer on Instacart. You're used to the way it works. So now they've got robots in these factories, and they pull all the groceries, deliver it to you, perhaps with autonomous vehicles and everything, the whole system being robotic and automated. They're going to put all these gig workers out of a job. I mean, that's how crazy things are, where these gig workers, whether it's an Uber driver or whether it's anything else, are ultimately just temporary, because at some point they want to eliminate those jobs too. This isn't a good sign, of course, but it's a trend that we can see. There are certain companies that are going to benefit dramatically from this. So as an investor, you could decide what you want to do in that case. But I'm just looking at the people who are in these gig jobs and noticing that, this is a finite timeline as far as I'm concerned for many businesses who are already putting money, billions of dollars into the technology to replace their workers.